Picking stocks can feel like searching for a needle in a haystack. With thousands of companies out there, how do you know which ones will be winners? Don't worry. Today, we're breaking it all down. In this beginner's guide, we'll walk you step by step through the process of analyzing, selecting, and investing in the right stocks without the confusion and noise. By the end of this video, you'll know exactly what to look for before you put your hard-earned money into the market. The foundation: know what you're buying. First things first, when you buy a stock, you're not buying just a ticker symbol or a number on your app. You're buying a piece of a business. That means you need to think like a business owner. Ask yourself, what does this company do? How does it make money? Does it have an edge over competitors? This mindset separates investors from gamblers because stock prices go up and down in the short term, but in the long run, the performance of the business drives the performance of the stock. The 3 golden rules of stock picking. Before diving deep into analysis, every beginner should remember these 3 golden rules. 1. Invest in what you understand. If you can't explain how the company makes money in one sentence, skip it. 2. Look for long-term value, not quick gains. The world's best investors, Warren Buffett, Peter Lynch, made fortunes by holding great companies for years, not weeks. 3. Diversify, but don't overdo it. Owning 10-15 carefully chosen stocks gives you balance. Owning 100? You're just buying the market without the benefits of focus. Fundamental analysis: reading the numbers. Now let's talk about the numbers, the backbone of smart stock picking. When analyzing a company, focus on these key metrics. 1. Revenue growth. Is the company growing sales year after year? A company that isn't growing will struggle to increase profits. 2. Earnings, per share, EPS. This shows how much profit is attributed to each share. Consistently rising EPS is a green flag. 3. Price-to-earnings ratio, PE. This tells you if a stock is cheap or expensive compared to its profits. For example, a company with a PE of 15 is trading at 15 times its annual earnings. Compare this to industry peers. 4. Debt levels. Too much debt can sink a company, especially when interest rates rise. Look at the debt-to-equity ratio to see if borrowing is under control. 5. Return on equity, ROE. A measure of how effectively the company uses your money to generate profits. Higher is better. 6. Free cash flow. This is the lifeblood of a company, the actual cash left after expenses. Companies with strong free cash flow can reinvest, pay dividends, or buy back stock. Qualitative analysis, beyond the numbers. Numbers matter, but they don't tell the whole story. That's where qualitative analysis comes in. Ask yourself, does the company have a strong brand? Think Apple, Coca-Cola, Nike. Is there a moat? A moat is something that protects the business from competition, like patents, loyal customers, or massive scale. Who are the leaders? Great CEOs can make a huge difference. Think of Jeff Bezos at Amazon or Elon Musk at Tesla. What trends support the business? Is the company in a growing industry or a shrinking one? Tools for beginners. As a beginner, you don't need Wall Street-level tools. Start simple. Financial news websites like Yahoo Finance, Google Finance, or Morningstar give free access to company data. Annual reports, 10K forms, are gold mines of information straight from the company. Stock screeners help you filter companies based on PE, growth, debt, and more. And remember, sometimes just looking around you helps. If you notice a brand growing in popularity, that could be a clue worth investigating. Common mistakes to avoid. Even the best beginners fall into traps. Here are mistakes you should avoid. 1. Chasing hot tips. If you hear about a stock at a party or on TikTok, it's probably too late. 2. Falling for hype. Just because a company is trendy doesn't mean it's profitable. 3. Ignoring valuation. A great company can still be a terrible stock if you overpay. 4. Overtrading. Frequent buying and selling racks up fees and taxes. 5. Impatience. Remember, investing is a marathon, not a sprint. Building a winning strategy. Now let's put it all together. A simple beginner strategy looks like this. 1. Screen for companies with solid growth, reasonable PE ratios, and low debt. 2. Research their business model. What makes them special? 3. Check long-term trends in their industry. 4. Start small. Invest an amount you're comfortable with. 5. Review annually, not daily. Give your investments time to work. Real-life example. Let's do a quick walkthrough with a real example. Apple. Revenue growth. Apple has grown sales consistently, especially with services. EPS, earnings per share, have increased year after year. PE ratio, compare Apple's PE to other tech companies. Historically, it trades higher due to strong brand and loyalty. Moat, Apple's ecosystem, iPhone, iPad, Mac, App Store, locks customers in. Leadership. Tim Cook has steered Apple successfully after Steve Jobs. Would Apple be considered a winning stock? Many would say yes, but remember, valuation matters. If the price gets too high, even Apple can be a risky buy. Picking winning stocks isn't about luck. It's about doing your homework, understanding businesses, and thinking long-term. To recap, treat stocks as pieces of businesses. Use both numbers and real-world insights. Avoid hype and stick to a strategy. Start small, stay patient, and over time, you'll build the confidence to grow your wealth. If you found this guide helpful, make sure to hit that like button, subscribe for more investing insights, and let us know in the comments, what's the first stock you're planning to research? Thanks for watching, and here's to building your future, one winning stock at a time.